but let's say $75,000 more than it was when we bought it. Hey guys, it's Nate. Welcome back to the channel. So today we're going to be talking about how I lost a ton of money in real estate and messed up my credit. So for this story, we got to go back to 2006. This was kind of when the real estate market was going really crazy. It was going really high. We had just moved to a new city and we needed a house to live in. So we started looking around and we bought a property, not knowing that we were buying at the high. However, kind of some of the factors, if I look back upon it, so initially our budget was in the 300s. But we ended up stretching that close to 500 because the market was just so crazy, and we got emotionally invested in the whole buying experience. Since this is a house, somewhere you're going to live for a while, naturally you are going to kind of tend towards getting emotionally invested into the process. So on top of this, interest rates were super high. I think our interest rate on that loan was about 6.75%. So our mortgage payment was already pretty high now on a property, much higher than we were expecting it to be. But what happens is when you're in this process, you just kind of get normalized to it because everyone's paying those high interest rates and property values are so high, you just kind of go along with the herd. And that was the mistake. Well, as you all knew, the Great Recession hit. So after the economy tanked, pretty much lost all of my clients to bankruptcy. There was no viable work there. So I had to move to another city. In that move, that meant that now I had to pay for housing in 2 different places. So at the time, this wasn't really something that I could afford on my income, paying for housing in 2 different places. So one of them had to go. So we ended up having to get out of that house, and the only way we managed to do this was we short sold it. So basically what a short sale is working with the bank to sell the house at a value that is lower than what you even owe on the mortgage, and everyone loses in this situation. So we lost our down payment, which was close to $100,000. We ended up losing about $250,000 total on the property. I had to sell the car I had at a time, which was the 2009 Challenger. I think I talked about it in another video. And on top of this, when you do a short sale, your credit goes down because you're basically writing off the loan for less than you owe. My credit at that time dropped over 100 points. It could have been worse, but since I had maintained payments on everything else, it wasn't that bad. So recently I took a look at that house to see, well, how much is it worth today in this crazy real estate market? That house is actually worth $75,000 more, and this is just a Zillow estimate. It maybe end up being worth more than that with the craziness of people bidding houses up more than $1 million over what people are asking for in some places. But let's say $75,000 more than it was when we bought it. So this goes back to something I talked about in one of my previous videos, which is you don't realize a loss until you sell something. And if you think that that asset is going to be worth what you paid for it or more than what you paid for it, and you don't really have an opportunity cost on the money in the meantime, if you can, hold on to it. In our circumstance, we couldn't because that would have meant 2 mortgage payments. But if you can, try to hold, if it makes sense. Sometimes you got to cut your losses. So check out this next video I put just down below. I think you're really going to like it, and I'll see you next time. Thanks. Bye.